Welcome back to our channel. If you're thinking about selling your business, I want to tell you a little bit about something that you probably don't give enough thought to. Your balance sheet matters more than you think, and a messy one can kill a deal before it even gets started. I don't care how good your P&L looks. If your balance sheet is confusing, sloppy, or full of mystery accounts, buyers assume the worst, and discounting the price they're willing to pay for your business begins to happen. In this video, I'm going to explain why buyers care so much about a balance sheet, what they look for, and what you can do to clean up yours before your business comes to market. Now, when estimating their business's value, most business owners focus almost exclusively on the profit and loss statements, revenue, profit, and most importantly, the discretionary earnings, what your business really earns. A detailed monthly P&L often shows the ebb and flow of the cash flow over time. A balance sheet, on the other hand, is a snapshot showing the condition of the business at a certain point in time, and it answers a different question that buyers have. The balance sheet shows how the business has been run. It reveals discipline, or the lack of it. If the balance sheet is a mess, buyers immediately start thinking, can I trust these numbers? And they start wondering, what else is wrong? What's going to show up in the due diligence process? What problems am I going to inherit? And if there's bank financing involved, a lender sees a messy balance sheet and it's almost certain the deal will not even reach underwriting. The importance of a clean balance sheet cannot be overstated. So let's walk through some of the issues that we see on a regular basis in several balance sheets categories or accounts. Up first, owner loans, or more specifically, owner loans that aren't really loans. We've seen accounts labeled due from owner, loan to shareholder, owner receivable. In most cases, this is just money that the owners took out. There was no repayment plan, there's no note, and there's really no expectation that that money is ever coming back. Nobody counts these entries, no matter what they're labeled, as assets. And having an account like this appear on the balance sheet just starts raising questions. Either classify these entries as distributions or owner compensation, or pay them back. Pay them back to the business. Either way, get them off the balance sheet. Next up, accounts receivable, or accounts receivable that are never going to be collected. Any receivable over 75 days past due is going to be discounted. Any over 90 days is likely to be deemed uncollectible by a buyer and therefore worthless. If you think that debt can be collected, get on it. But if that's unlikely, or if it's small enough to let slide, write it down to zero and move on. Get these laggards off the balance sheet. Overdue receivables signal deeper problems, and sometimes buyers will discount more than the face value of the receivable simply because they're questioning your controls. Inventory is another big one. Obsolete, damaged, or unsellable inventory must be cleared out or at least taken off the books. If your inventory normally turns 5 or 6 times a year, but certain items haven't moved in 18 months, you've got a problem. Get rid of it. Plug excess inventory buyer into your favorite search engine and get one of them out there to pick up what's not selling. Yes, you may only get 10 to 20 cents on the dollar, but that 10 to 20 cents can be used more productively for your business than keeping 100 cents on the dollar collecting dust on a shelf or in the warehouse out back. Get it off of there. The added benefit to this, your inventory number and audit will look much cleaner. Remember that if it's on the books, buyers will discover it during due diligence, and when that happens, price reductions begin in earnest. Furniture, fixtures, and equipment, FF&E. Like inventory, you should look hard at your FF&E for stuff that's old, obsolete, or simply no longer being used in the business. For example, if you have a fleet of 15 delivery trucks, but 2 of them are up on blocks out back and being used for parts to keep the other 13 on the road, get rid of those 2, get them off the balance sheet. They're not worth much money, and they're certainly not worth raising a buyer's suspicions. And you can be certain that a buyer will find this pretty easily once they start their due diligence. Other assets. Other assets accounts. We see this far more than we'd like to. What could other assets be? How come they are unclassified? Other assets are buyer kryptonite. If you can't explain an account in 30 seconds, it becomes a problem. Reclassify whatever's in other assets and move on. Eliminate that account. Excess cash. This is a good one. You got a fat bank balance? Nice problem, huh? No. Here's an example why from our files. A couple of years ago, we started working with a business owner on valuing and selling her business. It was a relatively small service firm, 1 office, 5 employees, but it was quite profitable. The business had a monthly run rate of less than $10,000. However, when we got the financial documents delivered, we were startled to find that the business was holding more than $800,000 in cash. When a buyer sees an unnecessary cash balance, they start to wonder why. What does the owner know that would require holding this much cash? Does a major piece of equipment need to be replaced? Is the HVAC system about to crap out? Does the roof need rebuilding? A balance sheet with far more cash than necessary to operate the business causes red flags to start flying. Dividend it out. Get it off the balance sheet. What about disputes? Are you disputing one or more payables or a loan or note balance? Does your balance sheet include something like set aside for XYZ lawsuit? No buyer wants to inherit a dispute, even a small one. Settle it. Get it off the balance sheet. Cleaning up your balance sheet does not mean making it look better than reality. You want to make it reflect reality. That's the objective. This process includes writing off what isn't real, inventory, FF&E, receivables that are unlikely to be collected. It includes properly classifying owner items. Get all those loans reclassified or repaid. And dividend out excess cash. A buyer should be able to look at your balance sheet and understand it without you being in the room to explain it. If it needs a long story, it's not clean. Don't wait until due diligence. It's too late. Don't assume buyers won't notice. They will. And don't take the position that you'll explain it later because you won't get the chance. And don't think a messy balance sheet can be fixed quickly. It can't. Once you're under contract or even an LOI, the damage is done. Ideally, balance sheet cleanup starts 2 or 3 years before a sale. That preparation can give you clean comparables and build better buyer confidence. They'll have more confidence in the numbers and other data that you provide. It could result in a stronger multiple, and it will almost certainly result in a faster closing by reducing the due diligence period. If you wait until you're ready to sell, you're likely going to take a discount to your business's actual value. Remove outdated inventory. Remove equipment that no longer works or is used. Settle loans to and from any owners. Write down uncollectible receivables and remove any other items that are questionable utility to the business's revenue, such as that Lamborghini the owner's spouse just had to have. Retitle it and bonus it out. Remember this, a clean P&L gets attention. A clean balance sheet gets deals done. Financial cleanup starts with the goal of delivering financial statements and documents that are clear, clean, and easy to understand. If you're thinking of selling in the next few years, start this process now. Remember, our objective is to make it easy for a buyer to buy. Start with making sure your balance sheet is clean and easily understood. Because once buyers find the problems, they price those problems into their offer, and the price that they're willing to pay begins to decrease. In our next video, we'll talk about the famous or infamous due diligence process, how invasive it's likely to be, and what you should expect. So subscribe so you don't miss that one. To help with valuing and selling businesses, I've included in the links below several resources that will help you do both. Finally, if you found this video helpful, hit the like button and don't forget to subscribe. In the meantime, thanks for watching. I'll see you in the next video.